Good morning, everyone. Welcome to Fasken's 14th consecutive mining series. My name is Michael Barassa. I'm with the Toronto office and part of the global mining group here at Fasken. Today's webinar, I wish, Ian, you could have picked a shorter title here, but anyway, novel solutions for access to critical minerals and other commodity supply chain challenges facing electric vehicle manufacturers and energy storage developers. Okay, got it. This is a 14th of our series of 14 sessions. It's the last one today, and in a way, thank God we're at the end of the PDAC conference. It's been a long conference, but a fantastic conference. But before I begin, I'd like to provide a land acknowledgement. At Fasken, we've embarked on a journey of reconciliation, guided by our Reconciliation Action Plan. As part of this journey, we believe it is important to acknowledge the land and the people who have called this land their home since time immemorial. Today in Toronto, where the PDAC conference is being held, we are gathered on territory that has been the home of many nations, including the Wendat, the Anishinaabe, the Haudenosaunee Confederacy, the Chippewa, and the Mississauga, the First Credit Nations. Toronto is also covered by Treaty 13, signed by the Mississauga of the Credit and the Chippewa. We appreciate living and working here and recognize the importance of working to advance reconciliation between Indigenous and non-Indigenous people here and across Canada. Please refer to the slide on your screen, those of you that are watching virtually. There's some housekeeping items there. And now with that, I'm going to turn it over to my colleague, Ian Palm, who's going to be the moderator for today, and he's going to introduce today's panel. Thank you.
Thanks very much, Michael. Appreciate it. And thanks for joining us today, both in person and online. It's really great to see everyone here. And Michael's joking around a little bit about the title of the discussion, but frankly, it's intentional. Like, I like getting into challenging problems, and it's kind of fun. This will be fun for me to get some understanding from some really smart people in the room here who are actively involved in solving this problem. And so I'm going to start from my far left here. Carlo Girolamo, excuse my pronunciation there, is Managing Director and Private Capital Advisory and Restructuring with Desjardins Securities. He's responsible for their battery materials investment banking coverage. He's got lots of experience in the space, both at Desjardins and other shops as well. And he's going to provide some advice from a capital markets perspective as to where we stand. To his right and to is Dominique Barker. Dominique is the Chief Financial Officer and Head of Sustainability at Lithium Royalty Corp. And before that, she spent a number of years working at CIBC in their capital markets group, and also with CIBC Asset Management, and was responsible for a range of things, including a lot of investment and strategy around incorporating ESG into their investment processes. And I guess joined Lithium Royalty last year, when it and I guess prior to its IPO. So welcome, Dominique. To my immediate left is Trent Mell, and Trent is the founder and CEO of Electra Battery Materials. Electra is I'll let Trent explain it to us when we get into some of the discussion here. Got an has ambitious plans for fully integrating and localizing and environmentally sustainable battery materials supply chain in North America, particularly focused on cobalt, but not exclusively. And Trent's a lawyer by training as well, and has extensive experience in M&A and capital markets in the mining space, but beyond mining as well. Also, and he's got experience in the as a board member of Toronto Hydro. So Trent, welcome. On my far right, Divya Shah is the managing director with Canada Infrastructure Bank. And before that, she was with Infrastructure Ontario, and before that, Manulife. She has extensive experience in doing infrastructure investing, and she's responsible for CIB's critical mineral sector and strategy and investing in the space. To her left and is and my right, or my not immediate right, is Brad Harker. So Brad comes to us from the United States. So welcome, Brad. Thanks for joining us. He I think it was last year, came to Toronto. He's the Foreign Service Officer with the U.S. Department of Commerce and the Foreign Commercial Service. He's the Principal Commercial Officer at the U.S. Consulate in Toronto. And before that, he had a number of interesting roles. His bios in the materials. He most recently was based in Hong Kong, and before that was in Beijing, and has had other interesting foreign service postings with the U.S. government. And he brings an interesting perspective that I'll get into around what the U.S. government's doing to provide financial and logistic support in respect of battery materials, amongst other things. And then our last panelist, who's right beside me on my right, is another guest from the United States. So thank you, Emmanuel. Emmanuel Dominguez is the director of EV critical materials purchasing at General Motors. And so if you've been listening, and I hope you've been listening, we've had some investment bankers. We've had a couple people involved in the primary part of the critical mineral space. Dominique's involved in the lithium side of things, investing in lithium. Trent's involved with cobalt in the processing of it. On the other end of the spectrum, we've got Emmanuel, who is really a purchaser of these end products, and the organization, one of the organizations, important organizations, that's putting these materials into vehicles and so that we can have more EVs on our roads and address climate change. Emmanuel's relatively new in that role, but has spent 18 years at GM, both based in Mexico and more recently based in Michigan. And frankly, GM's been doing some really interesting transactions, particularly over the last year in this space. And he and his colleague Simon, who's somewhere in the room, have been explaining to us some interesting transactions. So thank you all for coming. Thank you all for joining and agreeing to share some interesting insights. Here's the plan. We've got about an hour and a bit to walk through some interesting questions that we've talked about together. But we want to have this be a good discussion about some of the challenges in the battery material space. And so if you have a question, by all means, put your hand up. We'd be happy to take some questions from the audience or online. But we've got some questions we want to walk through as well. So I'm going to start off with Carlo and let Carlo walk us through kind of where we're at with respect to some of the challenges in the space at the present time, and kind of level set us from where the capital markets are and where some of the challenges are from some of the projects people are looking at. So Carlo, over to you. And we're going to have some slides go on the screen too.
Thank you, Ian. Good morning, everyone. I'll start with just a handful of slides. I'd like to set up the backdrop. I'm going to admit or explain, right up front. This is very much a Canada, U.S., North American point of view. I would say even more Canadian than U.S. for reasons that will become a little bit more obvious. I'm not going to ignore Australia, but there's less to say about what's happening in China or South America, but for reasons that, again, I think that we'll get into. Also, a lot of my comments may sound like they're focused on lithium for two reasons. One, lithium is obviously very important, but I mean, there are other commodities that are part of the critical battery material supply chain that there is less development in the capital markets, or there are less opportunities, or there are fewer data points. So I don't mean to intend, I'm going to use lithium as almost like the proxy for everything else. But I think the comments that are made with lithium and the data that I'm going to walk you through on with lithium primarily is indicative for the comments we can make about the broader capital markets and how the capital markets are or are not at the moment supporting the development of the battery material supply chain, largely in North America, which I think is what this panel is really intended to focus on. Okay, so this is a blinding glimpse of the obvious, the first slide. The prices are much lower than they were 12 months ago. Fine. What this doesn't give you the perspective of is 12 months ago, they were very high. So there was a peak, there was an unnatural froth in the market, and some people would say unhealthy in an unhealthy way. Maybe so, but all to say it reflected where we were 12 months ago when prices were very high. Everyone was going to buy an EV. There was insatiable demand for lithium and other battery materials, and mines were going to be built, and there are going to be tons of battery plants and whatnot. Okay, so for various reasons, for various commodities, we've seen the price certainly come off. We've seen lithium. It's a very interesting market from the point of view of it's largely dominated by China today and other Asian customers, because that's where the processing of the lithium that comes out of the ground is done. There's very little lithium downstream, middle and downstream processing capacity in the rest of the world. They are the buyers. So to the extent they don't buy from you anymore is going to impact the price. Nickel is a much more robust and transparent market. I think it's a little bit easier to see that the significant supply coming out of Indonesia is impacting demand, but yet no less important to the manufacturing of the battery material supply chain. Cobalt and copper. Copper has non-battery materials or non-battery uses, and I think those non-battery uses are more reflective of GDP and growth and development of global. So you've seen a little bit of more support in copper. Okay, that's where we are today. What does that mean for, I'm going to use lithium companies listed in North America. So the green line is TSX and NYSE listed lithium companies, and the blue line are those listed on the ASX. Again, I preface my comments by saying I'm using lithium only as a proxy for what other commodities or other companies focused on other battery material commodities are experiencing. And it's not good, obviously. So what happened is you'll see on the next slide that there was certainly a trend and a boom, and there was a lot of capital being formed in the equity markets for these companies. Where we are today is that these prices are certainly depressed. One observation, what you can see is that there's the trend is the same. These lines are almost on top of each other, but not exactly. And there's one interesting observation I would make between the companies listed on the ASX and the TSX. They're both down. They're both down almost exactly the same as far as trends go. There's a divergence in the value of Australian companies taken as an index. Remember, this is an index, not an individual company. There's been more M&A activity on the ASX, Liontown and Azure in particular, that has created this gap. There has not been as much M&A activity and therefore M&A premium built into the TSX listed companies. And that really explains the divergence here. So it's not like ASX companies are 12 to 15% better. They're just 12 to 15% more of a legacy M&A premium based on a couple of transactions that have occurred in the last 12 months and potentially anticipation of transactions that are going to occur in the future. That's what you see here. When it comes to capital formation, going back to the first quarter of 2022, the gray bar are companies listed on the ASX. The blue bar is companies listed on the TSX. You could see by far there has been way more capital formation in the public equity markets on the ASX. Anybody involved in the space and that isn't listed on the TSX looks at them with, as if, with great desire to be able to access that market. I live in the North American context, and it is very difficult, much more difficult. And it was even in the good days of, the early last year to raise capital from Canadian and US investors in comparison to what was happening in Australia. I don't have all the answers for that, but there are a couple of observations I would make of why companies were able, ASX-listed companies were able to raise more capital for their companies. And by the way, I just want to draw a distinction. These are companies listed on the ASX and the TSX, not the location of their projects. So there are ASX-listed companies with projects in Quebec, and there are TSX-listed companies with projects in Brazil. But I will say the ASX-listed company, regardless of project location, even located in Quebec, raised capital far more easily and successfully at a lower discount than companies with assets, companies listed on the TSX. Okay, we've got a couple of spikes here. I happen to have the pleasure of sitting beside one of the companies that caused one of the spikes, and we had a successful IPO for Lithium Royalty Corp. We have a spike at the end of Q4 of 23 for Liontown, but by and large, the trend is down. It's down on the ASX and it's down on the TSX. But I really wanted to use this slide in sympathy with the price. You can see the price really starts peaking in the middle of last year, but even by the middle of last year, people were getting uncertain. That high price was not helpful. It was helpful at the margin, but it was already causing significant discomfort amongst investors who were already saying, that's it. I don't like being around this. This just feels too frothy. But what certainly started to happen when the expected crash from an elevated height happened, it just reaffirmed what investors were thinking, and they just said, my chips are off the table for a while. And that's the moment we're living today. Today, there's really just a pause in the public equity markets. And I'm not saying the private capital markets, not the strategic investments, but right now there's a pause.
Sure, Carlo, go ahead.
Just on this point exactly. By the way, thank you for having us today. But one of the points that I wanted to make was on the cover of the Globe and Mail today cover story. One of the issues I think for this slide that's important to realize is that Australian superannuation funds have minimums to invest in their domestic markets, and in Canada. So right now, there's an open letter that's in the Globe and Mail today. With a number of approximately 60 CEOs from across Canada that are supporting the initiative put forward by Letco Brosseau, Peter Letco, who is an asset management company out of Montreal. And this likely explains this. And I can tell you that our CEO, who does some marketing in Australia, when he meets with some of the companies, they're like, we can't invest in you. You're not listed on the Australian Stock Exchange. So while some of our competitors in capital formation have that advantage, in Canada, we do not. In Canada, CPPIB invests more in China than it does in Canada.
Okay, so just keep going, but and I want everyone to stay with us. This is we're explaining the problem in some detail here. We're going to talk about some solutions, right? Okay, good. Okay, I just want to make sure. Okay, so if you're watching the movie, we're in the dark part, and Carlo's going to keep us. So as Winston Churchill said, if you find yourself in hell, keep going. So keep going, Carlo.
With that setup, Dominique, you're completely right. So the Australian listed companies have the benefit of a very robust retail investor base and an institutional investor base led primarily by their pension fund. And we do not have it at all, not on the Canadian side or the US side.
Yet.
Okay. Yeah. Okay. Now we're getting to the so what. Everybody has seen a version of this slide. This slide has lots of dots that demonstrate the existing, albeit very nascent, and anticipated and aspirational goal of a North American battery material supply chain, primarily midstream and downstream. So I know the dots are tiny, but really what it is, let's start in reverse. Let's start with the OEMs building EVs. Then they want to build battery plants here. Then they want to build CAM facilities here. Then they have to build a hydroxide or carbonate chemical processing facility here. And then you get to the dirt. These are the projects on the books. If you were to see the announcements, almost every single one of them start and end construction in 2025, 26, 27. Many of these projects are not yet being built. And referencing the slides I put, the previous slides I put, it will be very difficult to raise capital in the private markets, even if we started today, which we can't, to get these projects built. Okay. That notwithstanding, we have announcements by governments in Canada, the US, and the EU with commitments and targets to convert or ultimately have vehicles become EV exclusively, new vehicles sold by 2030, 2035, beyond. This is the question. I mean, I think this is where we're going, and I hope a big part of the panel is how do we realize that, knowing where we're at today, we're knowing where the capital is or isn't available today, and how do we realize these goals? If it isn't 2035, it's coming. Whether it's undeniable. But how do we build a North American battery material supply chain from the dirt all the way to the car? Before I hand off the mic, I will give a few observations. Most of the investment, largely from the government entities, whether they be a subsidy, a direct investment, a tax credit, a grant, has been focused in dollars, have been focused downstream. Let's start with the OEM. I use Ontario as a good example, only to say they are very good at investing with the automakers. They've been doing it for decades. So that's where we've seen the investment. New EV auto manufacturing plants. Take a step back, battery cell manufacturing plants. Where that investment has not yet been made, IRA doesn't get off the hook, is in the dirt and in the next step, chemical transformation. IRA announced $2.8 billion in grants to 20 companies, none of them for the construction of a mine. Dominique and I were chatting a little bit briefly, and she challenged me to say this, but where does the lithium come from? All these dots, where is their lithium coming from? It won't come from, right now lithium is primarily produced in Australia and South America. There's a single lithium spodumene manufacturing facility in North America. Siona's North American Lithium produces 160,000 tons. A drop in the bucket. Good, but a drop in the bucket, but based on investment that was made 10 years ago and 7 years ago. So I think a big part of the challenge is to realize these dots on the board and to create our North American battery materials supply chain.
Carlo, thank you. That's some cold water. That's like that. You set it's interesting opportunities, challenges in the capital markets. Some aggressive goals with regards to what governments want to see happen. But I think I look at it and I go, there's there's opportunities. We got some smart, educated people. We know where the minerals are. We've been building vehicles for more than 100 years. So the science is there. The question is, how do we get the materials into end product? And I think I'd like to focus us on that. And maybe I'll pass it to Dominique and Trent to maybe make some comments, because they're living and breathing this on a daily basis. How do you see, we're aggressively trying to solve supply chain shortages to get to our green transition. How do you see this at this stage? Do you want to do Dominique and then Trent?
I think Canada is really well positioned to benefit from this whole trend. And it's Canada's baking challenge. I just made it because we've got the ingredients and now we need to bake the cake. So we've got the labor, we've got the geology, we have the infrastructure. We have a clean grid. That's something that we are way ahead of many other countries in terms of having that as an input. If you think about the OEM corridor, when we think about Windsor and into Detroit, that waterway that's there, the rail that's there, these are all things that are really attractive. And so we're all set. This is a bit of an energy crowd, so I just want to say that in a value chain, no matter what the price is doing, so the price of lithium, if you own the entire value chain, somebody is benefiting. So if you think about the energy space, we've got E&P, or energy and production, exploration production in the oil sector. You've got the midstream, and then at the end, the downstream, you've got refineries. So we're set up. We've got the downstream. We've got a lot of the benefits of geology and labor on the mining side, and I think midstream is an area that really needs some focus now.
And the midstream is addressable, right? It's a little more than a factory floor, but you're not dependent on geology and Mother Nature to determine where you're going to build the midstream. So that's where we sit. We're building what will now be the only cobalt refinery in North America. And so when you think of, on the cathode side, nickel, cobalt, manganese, you mine it, you put it through a mill. Nickel, you'll send it through Sudbury, and that'll go into the alloy market. But that doesn't work for batteries. The smelters is the wrong processing technology. It's hydrometallurgical technology to make it into a chemical form. And so for cobalt, the facility we're building will be enough cobalt to put about 1.5 million vehicles on the road per annum once we're fully ramped up in about 3 years' time. Maybe a couple of gigaplants get satisfied by that supply. We've got roughly 37 battery plants have been announced in North America. So even if half of them get built, we're going to need a few more Electras, a few more cobalt refineries just to get that done. And so mining is hard, right? And this crowd will know that. It's geology. You're building and investing hundreds of millions or billions of dollars based on a bunch of drill holes and conceptual modeling. And so we know that's hard. We started at the bottom. We got to work our way up. I think there's a lot of angst, and I'm living it. I have concerns. I think we'll get there, but let's not forget we're building an entirely new supply chain that's going to take us into the next century and hopefully beyond. So we got to expect the bumps. We got to face the challenges, but we can't get comfortable. Yes, we are a nation built on mining. Canada is falling behind. We're already behind China, but I don't think we're showing the leadership and the poise and the urgency that the current situation demands.
Thanks, Trent. Thank you. So let's have a look at the other end of the spectrum. So we know at the other end of the supply chain. So Emmanuel, you and your colleagues at GM have been very active in this space. In the last month or so, you announced the transaction involving Nouveau Monde, and you and Panasonic have agreed to be long-term buyers of graphite from their facility in Quebec. Yep. Once it's operating. You were significant investors in Lithium Americas and getting the offtake from that lithium when it comes online. And so you're not shy to sort of look all the way down the value chain. Yep. And frankly, those transactions provide capital for projects like Trent's to be able to kind of advance and build a facility. I'm not saying you're investing in a Trent's facility. Maybe you are. I don't know.
Investing on Trent.
Yeah. Well, you guys can have that conversation later. But can you take us just so everyone understands how you think of those transactions from the end customer, and also the party that needs these minerals down the road? Can you give us a sense of how that plays out internally at GM?
Yeah, for sure. And first of all, thank you for the invite. It's very interesting to be part of this and really learning a lot and hearing a lot of the different aspects. So as you mentioned on the introduction, probably I'm a little bit of a disadvantage. I have been in this role for 6 months, so you can imagine how it feels, like drinking from the fire hose on this type of environment, right? But it's extremely fun and extremely challenging. So probably for answering and going into the specific with NMG, let me tell you a little bit about how GM sees this transformation. So probably I'll just share or change a little bit the word you're mentioning, Carlo, a little bit of the dirt, right? What we want to say is from rock to road, right? So that's really how we're phrasing all of this transformation on our space. GM decided, and it was a very conscious decision, that we want to be part of controlling our own destiny, right? So if we leave some of these investments, some of this development of the supply chain with some level of our support, of our deep interaction, then probably we're going to land in a place that it's not where we need to be. So a couple of years back, GM created what we call the Center of Excellence. And the Center of Excellence for the acquisition of battery raw materials is pretty much a multidisciplinary team that has collaboration from multiple aspects like financing, like legal, obviously on my end from the purchasing strategies space. And then we have a couple of others, technical, you name it, where we try to make these assessments and really paint a picture of what needs to happen for us to be able to develop this future, right? So part of that COE has like 4 big pillars for securing raw materials. Those 4 pillars is number 1 needs to be secure. And when we say secure, we mean a lot about the resiliency. Many of you were probably in different industries or different places, but you recall when the big tsunami hit Japan a couple of years back. I mean, it was a big, big learning for the industry. It took us many, many weeks, even months, to be able to realize all the interactions and all the links that were going to be broken in that supply chain, right? If you fast forward a couple of years, earlier this year in January, we actually had another challenge in Japan, obviously not to the same magnitude, but we were able to pivot from months of being able to understand our supply chain to now probably within hours, right? 48 hours to be able to understand that. So that's probably the first pillar of our strategy, building that security and that resiliency. Second one, we need to make it sustainable. And that goes back to a lot of the big benefits that places like Canada have from an energy perspective, from ESG standards, right? Then the third big item, and goes exactly to what you were saying and what you alluded, Trent, is what we call scalability. We know today we're at a level where we're going to continue to grow, right? And we need to make sure we understand how those timings and how those projects are going to be coming into life. And finally, at the end of the day, all of this in business means to obviously create great products, create experiences that excite our customers, but at the end of the day, these need to be profitable, right? So this is also another big challenge when we focus about cost competitive. So those are probably the 4 pillars. That's how GM sees the supply chain. And then if I just focus and zoom in a little bit into NMG, we announced our agreement with Novamont a couple of weeks back, February the 15 or 16, I don't remember. But it was a collaboration with not only us, but another anchor customer that it's Panasonic, and then a couple of strategic investors and Mitsui and a couple of others. So for us, when you try to map out the 4 priorities that I mentioned, and you lay those against the priorities and the value that we believe NMG brings to the table, there's a very clear correlation. And without going into all of the details, but NMG has been flagged as one of the leaders from a sustainability standpoint by third parties, by benchmark, where they are ones that have most of the best ESG practices in the world. And then when you look at, their carbon footprint, they are one of the most energy efficient ones. And then, being able to fully develop the supply chain where you're not doing mining in one side of the world and then processing in the other side of the world, that's another very, very big benefit of that, because we have a fully integrated solution with the mine in Matawini and then obviously the processing facility in Bécancour. So again, it's a lot of this alignment of priorities that come together. So that's how we see it and the things that we look for. GM has been very active, to your point. Probably another big deal that we announced probably the week before was an agreement with our LG partner, with LG Chemical for cathode active material, and that was a new plant in the US, in Tennessee. And just to share a data point, the amount or the value of that contract over 10 years of life is going to be around $19 billion. So, it's just another example of how committed we are on meeting all these 4 requirements that I mentioned and how we see the alignment. So that's what I can share.
Well, thank you. That adds a lot of light to some stuff that and provides some real substance to why this is important. And why we should be continuing to focus on it, even when prices in certain commodities are lower. This is a long-term retooling of our supply chains. And I want to bring Divya into the discussion here, because I think infrastructure investing and frankly, the stuff, some of the stuff that the Canada Infrastructure Bank's doing is really important to help build the foundation for a lot of this stuff. And so, Divya, do you want to give us a sense of where you see this from the standpoint of a strategic investor providing support in the space.
Absolutely. And thank you, Faskens, for inviting us and being a part of the panel. I will say I'm fortunate to be a part of the solution here and hearing all the challenges that the market is facing, because for us, that's opportunities. From a CIB perspective, we launched our critical minerals strategy in about June 2023. So we're a fairly new player in this market. And for people who don't know CIB, we are a federal crown corporation. We had $35 billion to invest across a variety of priority sectors, of which earlier this year we've announced 11 billion in commitments in 56 projects. So anyone doing quick math, we've got a lot of money to invest and we love this sector. So that's the start of the good news. When we created our strategy, we have a two-prong approach. Prong one is to work directly with private sector across the value chain. So I know it was mentioned the governments like to work only on downstream. We're looking at it from the other spectrum. So upstream, midstream. Downstream is something we won't touch other than recycling. So that's part one. Part two is we would look at sizing our investment based on the infrastructure components in a project. And it's a sizing metric. It's nothing else. Once we size it, money is fungible. It becomes a part of your capital stack. As a part of the capital stack, we can play either as senior debt in the club, but the thing we can offer, which is beneficial here, it seems, is that we can go longer tenor. So commercial banks like to go 5-6 years. We can go 10 years, 15 years, depending on the mine life. And that seems to provide some relief in the earlier years when it's more volatile. Another thing we can do as a product, which again is interesting because we're hearing equity markets are difficult, is providing a sub-debt product. So we rank behind senior debt when it comes to default, security, but we can alleviate some of the equity raise issues that are coming up. And this piece provides a buffer to debt. It's cheaper than equity, but it's beneficial across the stack. And we're very happy to take those kinds of positions as long as there's equity partners that are credible behind us. So those are the two things. Now, the third thing is terms and conditions, tenors. We're very open-minded to look at things creatively. If I leave one word with you across the board, it's flexibility and creativity that CIB brings to the table when we're thinking of solutions. So that's prong one, working directly with private sector on their projects. We've just initiated prong two, which is our strategy working with provinces and government agencies to build infrastructure that unlocks mining regions. There's a continuous debate on chicken and egg as to who builds a road, and if the road is built, will the mines come? Will the mines come? Will the road be built? And we're putting our hands up and saying that's a risk we would like to take. We would like to take the build it and they will come risk, working alongside our indigenous partners, our government partners, and the private sector. So if I can bring the financing solution, can the rest of us come together and collaborate to make these projects that have been stuck for 10, 20, 30, 40 years? And so those are the things that we are working towards. We don't have the answer for everything, but hell, we're motivated.
Well, thank you. No, it's like that, and you've been doing some interesting, groundbreaking transactions, and I think you're in a position to be able to convene groups of people to say, look, how do we solve these problems? So thank you. I want to get our last panelist involved, Brad. Emmanuel mentioned security of supply chain, and I think we're in addition to talking about EVs and climate change, we're also in a pretty challenging geopolitical world these days, and I think building a supply chain within generally friendly countries is, I think, important to all of us, and I think the U.S. has been doing some showing some really interesting leadership, and also doing some interesting substantive things. So I think, and many people will know, the U.S. announced last year that $250 million in Defense Production Act funding for both U.S. and Canadian companies involved in mining and processing critical minerals for EV and battery storage. I don't want to steal your thunder, Brad. I'll let you kind of walk through stuff. Brad's got some slides too, but do you want to give us a bit of an update as to where you're at? Because I think, U.S. government support in respect of funding both, U.S. and Canadian projects, I think is again going to help us advance so many of these projects, and we're excited to hear where you're at in those.
Yeah, thanks for that, Ian. So basically, I wanted to kind of provide a quick overview of where we're at as far as U.S. and Canada in particular, since the Biden administration came on board, has really been focused on creating the policies required to really move the process forward with respect to not only strengthening the U.S.-Canada efforts in critical minerals and the entire EV supply chain, but also to leverage existing programs that we have within, in particular, the Department of Defense Defense Production Act. Canada has always been a domestic supplier. It's only in the last several years that it's really started under the DoD funding that it's really started to move toward utilizing some of these funds under the DPA to start investing in rocks in many respects. A little bit about us. So ITA, so I work for the U.S. Department of Commerce, International Trade Administration, U.S. Commercial Service. Our job is really to help American companies compete and win globally, and then to help Canadian companies in this respect, or companies around the world, to invest in the United States. So certainly the IRA, the Inflation Reduction Act, has been a huge boon to attracting foreign direct investment, particularly in the EV space. But under this renewed partnership that was signed with Prime Minister Trudeau back in 2021, ITA was put in charge of a critical minerals working group to help really coalesce and bring together all of the different agencies that are responsible and have funding to and be able to really market it to both U.S. industry and Canadian industry. So what's really interesting is the fact that most recently, a few months back, both the UK and Australia were also added as countries that are included as far as suppliers under the DPA Title III funding. So this Defense Production Act investment is, and we can send this out after this, is a really interesting slide. So we have roughly the last several years, it was $250 million in 2023, and there is a really nice slide that goes through actually the allocation for these projects. And so I think what is really interesting to note is there is exploration, there is feasibility studies in areas that we need to see moving. There is $90 million to Albemarle to get their Kings Mountain lithium mine back up and running. We have one Canadian-related project with South Star Battery Metals Corp. It's a Canadian firm that got $3.2 million to move forward a feasibility project for a graphite mine in Alabama. I think what you'll see in the coming years is a much more accelerated expansion of DPA Title III funding for Canadian, Australian, and UK opportunities. I think it's really the message that we have got at ITA and really across the government is get it moving and start marketing these opportunities to Canadian, and now UK and Australian upstream, midstream. We've done plenty of investing and providing funds to likes of General Motors and everybody else to build the downstream, to build the battery factories and the EV. So that's, as Carlo said, we've got way more than we can probably actually build. But the real point is we've got to get the upstream and midstream moving. And so that's where DPA Title III is coming in, expectations. Hopefully, if we get a budget, which we're all waiting for, the expectation is roughly $1 billion in DPA Title III funding for 2024. And then I also wanted to bring in a couple of other areas that hasn't been traditional. Exim Bank has gotten the message. So they have stood up their own critical minerals transaction under the China and Transformational Export Program. And so they have traditionally required very high bars of US content requirements and the like, and to help speed up their investments, similar to what Canada is doing, is being more flexible, being able to take a look at projects and become one of a primary player that can bring in the private equity and the additional investments to get these projects over the finish line. So XM is important, and then also DOE. So our own Department of Energy has large slugs of money. These guys can be a little bit more of a black box, I must say. But really the message to Canadian industry and US industry is, well, reach out to the likes of me or my counterparts to get boots on the ground. I mean, I take Trent as a great example. He is running around meeting with everybody to make sure that his project is known within circles of what's possible. And so really, in many respects, it's a white paper that is compelling, that's real, followed up with a lot of sit-downs and explaining exactly what is happening with individual projects so that there can be, again, an understanding across different funding mechanisms for what's possible. So again, the U.S. is pivoting. It is moving an aircraft carrier as far as taking the resources that are available and actually deploying them. But by all indications, it's going to be accelerating pretty dramatically now that we have the mechanisms in place and really the policies. I mean, the IRA is a 10-year program that is going to supplement and encourage the purchases of that new Cadillac Lyrica, beautiful car, by the way, as we move forward over the next 10 years. So.
Thanks, Brad.
Yeah.
I think those are really interesting opportunities, and frankly, exciting collaboration opportunities involving both U.S. government, Canadian government, and other sort of friendly groups as well. I kind of want to get down to more substance and actual deals. Trent, maybe you want to reflect upon what we just heard Brad describe, and also what Divya has described. You're actively involved in sort of building your cobalt refinery facility. Where are you at, and how does some of these funding tools across the board, how do they play into what you're doing?
Yeah, so we are, depending how you want to look at it, call it 3/4 done. We got our permits, the buildings are there, the infrastructure is there. Divya called me a couple of times asking if she can help. We got all that. All of our long lead equipment is there. As a pre-revenue company, we just got stuck in the realities of a post-COVID world with inflation that I haven't seen since I was a very young boy. And so paused our project, and we're close. And that's the challenge that we have in the West, is China's not only ahead of us, but it's the capital. On an operating basis, our plant can compete with the Chinese facilities on an operating cost basis. And our carbon footprint is half of that. Freight, 1/10 in terms of the CO2 of moving the materials. And so that's the easy part. The hard part, cost of capital in the West, particularly at our stage as an early stage company, relative to China, which is almost zero. And then the added pressures of the vast amounts of money that is available in America, right? So you've got the two largest economies in the world are kind of poles. Why would you invest in Canada when you've got America responding in force to China with programs that are very flexible. They're not only well funded, but there's a fair bit of versatility. Infrastructure Bank doesn't work for us today. EDC doesn't work. BDC doesn't work. We announced something called the Canada Growth Fund 2 years ago. Nobody knows what the rules are yet. So it's great to have a program with a lot of money, but when it's not going out the door, doesn't matter. Strategic Innovation Fund. We spent all our money on battery plants, and now we're waiting for the next budget to see where that goes. So where does that leave us? Well, it's scarcity value. When the Biden administration announced foreign entity of concern rules, so you cannot, if you want to get a vehicle credit in the US, you can't be buying battery materials from an entity that's 25% or more controlled by China starting in 2025. The very next day, one of the largest EV companies in the world called us up and said, we need your material now. And we said, well, we're kind of sold out, and you're going to have to invest in us if you want access to that material. And so there's a lot of tools out there, but it's not equity markets. Private money, I think we're going to start to see a little bit more of that. The greatest, in addition to our scarcity, the greatest tool we have at our disposal, and it's a bullet you can't spend too soon, but it's the metal, right? A lot of traders will want to intermediate that, prepayment facilities. And so there's a lot you can do, but there are so many startups and there are so many kind of show me stories out there that you do have to have your asset de-risked to a certain point in time before people are going to want to trade in your future commodities. So for us, we're being, we're in a rush to get it done, but we got to be judicious in how we structure debt, equity, prepay, strategic investments, downstream, and then of course the government programs. So no silver bullet, but it's the most important part of my job and probably the biggest piece of my day-to-day activity of late, just getting that funding sorted out. Yeah. Please go ahead, Dom.
Yeah, just to add to that, I've been reflecting, given one of the themes from PDAC really has been, where's the midstream? Like there's all of a sudden this urgency on the midstream. And I used to cover infrastructure when I was at Credit Suisse as a sell-side analyst and trying to understand what is the definition, like what made midstream such an attractive investment? And so just thinking about that, and one of the things that I reflect on is that in the energy space, what made midstream attractive and what makes real estate attractive as investments, for example, for pension funds, is the contracting. And so I think that is maybe, and today it's such a nascent industry, critical minerals. Today, what's taking place in terms of trying to satisfy that, I think, is the concept of offtakes. And so we've got, for example, that's great counterparty credit risk, right? When you have a GM taking on that. And so then we can really start to think about these assets being midstream. So let's look for, and to solve this problem, let's think about the energy sector and think about contracting as helping to solve that problem.
Well, that's a good segue. Oh, sorry, Carlo, you want to say something?
Yeah, I want to pick up on Dominique's comments. She's absolutely right. Midstream, it may have sounded like we're spending a lot of time on mining in some cases, but midstream is hand in glove with the mine. And the reason why midstream is attractive is two reasons. One, it unlocks the value of the mine. Breaking rocks is valuable, but not the most value. The conversion of the rock to the chemical as the next step and the infrastructure that is the chemical transformation is very valuable. But that is also a fundamental aspect that needs to be developed here as well. So I think we're starting to see inklings of that. That Frontier deal that got announced is actually, a little bit of a breadcrumb of what's to come. But I think that's where, when it comes to attracting capital, it's going to happen at the midstream for sure. And then that is also going to go hand in glove with the rock that supplies that infrastructure in the first place. They can't happen without each other.
But wait, sorry, one more thing for the lawyers in the room and for just to create the solution. I just don't have time to do this because I started to look at it and my source is Wiki, but so meaning I haven't done the deep dive, but one solution could be like looking at, for example, the way the Northwest Upgrader was done, which is now the Sturgeon Refinery in Alberta. And that had a lot of government funding and it was related to using some of the government-owned oil and gas to back some of those contracts. So anyways, and for any creative minds out there, there's an idea.
All right. I like that. I was going to go to Emmanuel next and sort of, from your perspective, what's attractive? So, I don't think of traditionally large auto companies investing all the way down through to the mines itself, the rocks itself, and obviously we talked about the fact that having GM as a credit risk creates some value for people in the midstream. But from your perspective, I guess the alternative would be to simply sort of wait for them to pull this stuff out of the ground, and you can buy it when it's available. What are the advantages to entering into offtake agreements and other kind of arrangements? I mean, I can think of some obvious ones, like you've got long-term supply confirmations at prices where you can sort of figure it out. But what other elements go into play into you making those decisions?
Yeah, thank you. And probably before answering your question, I'll just pick on some of the comments about the processing. For us, it's really amazing how many times we get approached by a mine or a different player and say, hey, I have this rock, right? And I'm willing for you guys to take it on and have fun. And we're like, okay, and what about the other part? So I know we need each other, right, to solve some of these challenges. But yeah, I just want to stress that. So answer your question. I believe, depending on where the assets are and how we're planning to develop them, there's multiple advantages that we see. And obviously being here in Canada, I'm going to probably touch base on some of those, right? But for us, being on an environment that provides a very regulated and very stable framework for operating, it's definitely a great advantage, right? So we look for that because our investments, as you point out, are long-term, and we need to make sure that they are stable in the long term. The other benefits that we get from, offtake agreements, as you point out, number one, very obvious, security of supply. But also, if we are able to play into the early stages of some of these deals, we can build in advantages for our sustainability long term. And sustainability, I mean here, for example, commercial benefits. If sometimes we take partition of some of the investments or some of the development of the process, we have benefit from a commercial and from a pricing aspect. Also, we are able many times to create certain levels of flexibility within, how some of the processes are going to work. And let me probably tell you a very obvious example. Many of you probably are familiar with the multiple chemistries that we have into the EV batteries, right? I mean, you can argue you have the high nickels, you probably have mid nickels, and then you probably have LFP that it's becoming very, very famous here recently, right? So if we're able to work together at the beginning into some of these offtakes, we can work with our potential partners to have that flexibility as needed. And the big example is lithium, right? Lithium on the processing side, if you're going to be doing a high nickel, then you need hydroxide, right? But if you're going to moving into, LFP of mid nickel, you need to transition from hydroxide into carbonate. And those are things that probably sound very obvious to many of the people that are part of this industry for a long time, but being able to create those alternatives as needed and the ability to pivot as, the market changes is something that it's very, very valuable. So that's another piece. And I would say the other thing that we look when we're creating this is our opportunity to really make hubs and make as much vertical integration as we can. And probably the best example that we have here very recently is our facility, our joint venture with POSCO Future M in Bécancour, right? It's going to be one of the first, if not the first facility that it's going to have a full vertical integration of CAM, leveraging the mineral resources that are available in Canada with probably nickel coming in and, a couple of other things that we can vertically integrate. And that way, it's also an opening for us to be able to compete and create value. If we're able to collocate many of these things, probably we avoid the steps like crystallizing materials, and then we just pipe stuff, right? So those are things that we can be creative, and when we can become more competitive by creating hubs and, again, vertical integration.
And take costs out of the process.
Correct.
And reduce timing, and also...
Yep. Because if we aim to probably repeat the same process, and I know we all mentioned China, right? But if we aim to repeat processes that are available there, it's either not possible because, standards are different, availability of materials is different, and again, simply not possible, or just the cost is never going to be able to pencil out. So we need to collectively work on these ideas to try to make it a little bit different and think a little bit outside of the box. And I know that's an easier comment, right? But that's what we look.
You can build a facility like ours in China or in Taiwan for a third the price. It won't meet the same standards, and it probably wouldn't be good for wintertime. But yeah, that's the challenge. It's not just cost of capital, it's the capital cost of the facility itself. So from the downstream perspective, like for an OEM, the easy route, if you look at how the supply chain works, is say, you know what, we're going to onshore cathode and cells and the plants, but PCAM, let's keep that in China, right? It's hard because that's, you need the nickel and nickel manganese and cobalt. And this is where government policy is important, because from a bottom line perspective, it would be easier to onshore the bottom half, leave the rest of it in China. It's there, it's easy, it's already established, and it's cheap. But from a government policy perspective, we've got a polarized world. We can't be buying from China and from Russia in the current environment and expect that we're going to have our security interests looked after. And this is where the incentives, the stick, the carrot, whether it be a carbon border adjustment taxes or an EV credit, this is where we need to cajole, I suppose, the OEMs to help out in some bigger issues that are bigger than just the OEM themselves.
Yeah.
And I will just pick up on your comment, Trent. For us, it's, building blocks, right? And I have a 9-year-old and he loves Legos like many kids, right? So every time that I see him playing, reminds me of, how each one of these individual pieces of the chain build on each other. So to your example, we will be able, let's say, with some of these investments to figure out a solution for, let's say, nickel, cobalt, right? And we do it that locally. But unless we're able to figure out the next step, that it's the PCAM, then you're still relying on sending stuff overseas and then bringing it back. So it's, the mine, the processing, the PCAM, the CAM, and eventually the cell. And all of that is working together, or that's the goal.
All right.
Sorry, Ian.
Yeah, go ahead, Carlo.
I don't want this point to be lost. What GM has done with the Bécancour facility is remarkable for a number of reasons. It so far has not been replicated. It will have to be replicated. Yep. But going back to the doom and gloom I may have talked about at the beginning, this is the way the industry is going to get built. It's going to get built. Like, for example, what I'm describing, and I think, Emmanuel, maybe you live it, but I want to give a lot of credit. They've developed a battery materials park in Bécancour, so that means it's in Quebec, that is going to, the vehicles are going to be made here, the battery cells are going to be made there, the PCAM is going to be made there, and they're going to be sourcing the raw material from hundreds of kilometers away, not thousands of kilometers away. Yep. And how did they do so? It's not just a offtake agreement. No. Offtake agreements work as long as there's product. They've actually written checks into the assets and will write more. They're not done. Okay. We are waiting for the similar announcements and initiatives from Stellantis, Ford, VW, BMW, Mercedes. I mean, that is all to come. I'm confident it'll come, but I want to acknowledge that GM did it first.
Thank you for the endorsement.
All right. Well, let's continue the loving here. Thank you. No, that's great. And frankly, and it's all clean energy, right? Like, it's all, so we want more of that. And so, to extend the kind of Lego analogy, my kids like to play Lego and also Minecraft. Divya, you've been sort of seeing stuff on a regular basis here. To what degree are investors and are looking at sustainability goals as part of their analysis of projects you're looking at and you're actively involved in investing in? To what degree do they play an important role in your decisions?
So I love this question because CIB is not, we have bank in our name, but we're not a regular commercial bank. So what does that mean is we don't have hurdle rates. We are an impact investor. And the way we measure success is outcomes or impact divided by every dollar invested. And impact for us in the mining industry is, I'm going to say, almost 3, 4, 5-fold. We start with the fact that this is GDP, indirect, direct, multiplier effect, all of those good things. That's what helps us make a business case internally on why we need to invest in this industry. But then when you go just in parallel or a step down as a secondary benefit, and it's not a secondary, it's actually a primary benefit, is benefits to the indigenous communities. All of these projects, a lot of these projects in the mining upstream, are all in remote areas. And we are hoping that as we're building roads, we're converting winter roads to all-season roads. As we're building transmission lines, we're connecting transmission lines to communities, so they are going off diesel. And for us, that is really important from an impact perspective, because we look at that as transformational. That's the definition of what CIB was built for. And then lastly, you cannot ignore that all of this is leading to the digital and green evolution. And without all the work that everyone's doing here, we're not going to get the GHG reduction that we want. So we look at all of those elements and say, if this is the impact that this industry is going to have, if we start investing in it, the transformation that it'll have in the Canadian economy just cannot be counted. So we need to really work hard. But we're seeing our partners on the other side knowing that that's really important. They are coming up front and wanting to invest alongside or giving ownership benefits to Indigenous communities. And we have programs at CIB that help benefit that. We can provide loans to Indigenous communities to buy equity stakes in a transmission line. So I think there's a complementary benefit here. There's a lot of companies that we're speaking to are also looking at, well, if we go to a small nuclear reactor, if we look at carbon sequestration, if we look at a transmission line, from a long-term resiliency perspective, that's going to be better for everyone in this country. And so we're seeing it on both sides, and we're doing everything we can to make it an attractive solution so that they bring those solutions to the table that will benefit not just bringing mine out of the ground, which is extremely important, but it also has extra benefits.
That's great. Can I pivot a little bit to, Dominique, you brought up the Canadian pension plans and the announcement in the Globe this morning. And Trent mentioned cost of capital, and it's hard to compete with China. We're talking about other potential benefits to making these investments. As an investor in this space and someone who's got significant experience in sustainability investing, what's your reflection upon some of that stuff? How do we convince our pension plans and other institutional investors in Canada that this is an important space to invest in, even if the cost of capital for Chinese is next to nil? What's your thinking on that?
Yeah. Maybe just to start with a stat. This is from Let Cobra. So they did an analysis, and just 10 years ago, so it was 2011, so 13 years ago, Canada's mining industry was 1.4 times Australia's in terms of capital on the capital markets. Today, Australia is 2 times Canada. So I think that's a direct impact from some of the advantages that Australian companies have by the superannuation funds having minimums to invest there. So I'll just leave that stat there. But in terms of convincing traditional investors, I will be honest that from an investor perspective, buy side, nobody likes to catch a falling knife. And today the knife is falling. So I have no doubt in my mind, I've never been more positive for the lithium sector and for the EVs. I just bought one myself. I do think that the demand is there, and I do think Canada has put its stake in the ground in terms of making it a driver for our economy. I have no doubt in my mind that things will turn more positive, but from an investor perspective, this is a difficult moment. And so we do need to see a switch in the change. And just another stat, we've talked a lot about where that processing capacity is. Nobody's said the number yet, but it's 88% of processing capacity is in China today. So that's where I think in the short term, there's been a buildup of inventory. We estimated in January about 4 months of inventory build. So we're into April here. That's why I believe we're starting to see a bit of life on the lithium side. But so in the short term, that's that inventory drawdown. But the long term, we need to get some of that processing capacity out. And also it's a nascent industry. So this fluctuation and volatility is not abnormal.
Add to that. The upside of where we are in the resource cycle is that the battery costs are coming down. So maybe it'll help with penetration, right? So there is a good side to it as well, which will then in turn pull on demand. But in terms of the investment universe, so at least in the resources, you'll have the resource investor that'll play the commodity swings, right? The money will ebb and flow. In the midstream, I think this is where private capital gets interesting, and pension funds, and because these are 100-year assets, and the way we've set up our contracts, we never lose money. We're not market facing. It's a margin that we've negotiated with LG, our biggest offtake partner. And the agreement there is they don't want us to go under. And so we've removed the troughs and the peaks, and it's a very steady state. Now, yes, it's an 8 or 10-year payback on your investment, but thereafter it's a steady dividend type operation. So midstream is a very different investor profile. I think if we can, in fact, as I've started to talk at the BMO conference last week, not about our cobalt refinery, but about our future plans for nickel refining. Now it's a more interesting asset because it's a bigger part of the battery, and it's a bigger investment. Instead of $200 million, it's $1 billion. The check sizes of 100 million or more, they work under that business model. As Canadians, sometimes we're a little less ambitious than we need to be.
Sure, but if you've proven you can build the cobalt mine and it's generating revenue and all that stuff, then
you got the expertise and the team too.
Yeah.
It's different commodity, similar skill set. Yeah.
Right.
Yeah.
So we need to see a bunch of successes of that nature.
And to Dominique's point, since the expertise is largely in China, hydrometallurgy is not. I mean, we've been doing it for 100 years, but yes, we need to build the expertise here in Canada and in the U.S. so that we can leverage that skill set across the board.
And it wasn't forever. It wasn't in China forever. Like we go back 25 years and
Kid
wasn't.
Creek, yeah, we've had it here.
Yeah. So it's a matter of kind of turning the lights back on and okay, how do we make this happen? And
it's not the battery recycling, which we also play in. There's a little bit of a new science there, and depending how creative you want to get with black mass rate to a cathode, it can get a little bit black boxy, but primary materials refining, yes, there's nothing novel. What we're building is no different than what we see in Finland and what we see in mainland China. It's capital, it's time, it's permits.
Okay. So we've got a little bit more time. I've got about 7 other questions here we didn't get to. So if you want to stay till about 10:30, 11, maybe we'll bring in some lunch. No, I'm joking. We could probably go on for a lot longer. There's some really smart people here. I kind of want to give an opportunity for anybody from the audience to raise some questions.
Thank you very much. Very interesting. 2 quick questions. Do you see any solutions for the dirt, mainly on the junior side? It seems like it's very tough to look forward to the supply in many of these critical minerals because it's very difficult to obtain raise capital for junior companies. That taking into consideration that many of the critical minerals, they're strongly based, if you get out of China, for example, in South America, like lithium or rare earths. And the second question would be, how critical are the rare earths in all this system?
Maybe I'll let Brad talk to rare earths in the U.S., but I started my mining career in gold. It's a hell, can I say hell on the? Sure. Hell of a lot easier to build a gold mine.
I already said hell.
Than a base metals mine, right? Because you mine it, you put it through a mill, you got a near pure product. Yeah, a little bit of upgrading, but working capital is minimal. They're easy to build, they're easy to ramp up, and cash flow is instant. When you're talking base metals, bigger operations, more processing, more working capital. And so when you look at the world of mining, a lot of juniors, there are going to be a lot of failures. That's just kind of the way it is, and probably the way it has to be, right? We got to figure out what's under each parcel of land. There could be a mine under this building. We may never know, but you got to go through that process. And ultimately, investors, and in this case, governments, you got to pick your winners, right? It is survival of the fittest. And Canadians may not like that, but I've said it a lot. Don't sprinkle money to everybody, because that's not efficient. It's not going to get us where we need to go.
Okay. Brad, did you want to say something about that too?
Yeah, and is this working? Yeah.
Yep.
And I would say that's really where having especially for the juniors that have some really compelling opportunities, is really get plugged into what we've been doing, at least at Commerce, in doing the promotion of the DPA Title III opportunities. get a mentor within somebody like Trent who's going through the process, or in crafting the kind of white paper that's going to be compelling to at least get your project reviewed further. I can tell you that, as I mentioned earlier, the expectation is a lot more focus on upstream and midstream, to be able to do exactly what GM has been able to accomplish, and what Carl was saying, that we got to have similar kind of, well, from rocks to batteries, being able to do it. So that's where I see, and I also see leveraging a lot more of leveraging of existing assets. I had a very interesting conversation with an American company that does uranium processing in southern Utah. They have the ability to take sand, forget the mineral in it, full of critical mineral sand coming in from Brazil and Africa and parts of the U.S., and with their existing facility, grow it to be able to process the up to 4 million 4 million vehicles worth of magnets. So again, I think it's understanding that there are tools, having something that's really compelling, and then executing.
Yeah. And we've got a entrepreneurial society, like we in the U.S. and Canada and Australia and other parts of the world. We're eager to take chances, and I think, frankly, there's going to be some failures, like you've mentioned. But I think for the ones that are that we want to see be successful, I think each of you have described, how you can play a role in surfacing those projects that we need to be successful. Whether it's Canadian government investing, U.S. and government investing, customers. Looking at long-term supply, or in the investor community, or Carlo, myself playing a role in structuring these transactions. I think we got time for one more question. Sir?
I had a comment and a question. Just looking at my own practice, there seems to be a bit of a contrast in terms of speed. The speed with which capital can be deployed by the PRC entities, and also from friendlier sources like Australia, for example, and the speed at which government programs move. I can recall it at one point in time looking into the Defense Production Act for a client, and I was told that there was going to be an intake in 6 months and that a white paper would need to be drafted. It's hard to convince clients to pay you your hourly rate to draft white papers. So when you look at that difference in speed, my question would be, has there been any thought given to potentially outsourcing some of these functions for deploying capital, like simply picking up the phone and saying to Eric Sprott, this is how many billions we have and these are the outcomes we want, and we'd like you to put 50% of it into mineral processing? Would that potentially be a more efficient approach?
Does anyone who wants to take that question? Look,
At the right end here.
yeah. And Brad, do you want to comment on that?
I mean, I would say, we've been working a lot with DoD, and there is understanding that the current process can be quite cumbersome. I think there is an expectation for a more streamlined process that won't require a multi-100-page white paper. So really, I think that there is a desire to speed up. Funding is available. Just the IRA alone is immense, and different pools of money on that slide I showed you. So DPA used some Ukraine money for 22 and 23. IRA funding, big slug of that was for 23. And then we've got approximately $1 billion coming online, knock on wood, for 24. But really, I think, again, everything that we are being told within the U.S. government agencies is speed it up, be more flexible, and help get projects moving. So whether it's DOE, which is much more on the technical and creating the technology side, versus the DoD, which is funding to actually get things built, or feasibility studies, or the like. now is the time really because really since 21, that's when the Biden administration really put forward massive and our own to counter our own really industrial policy to be able to speed up and create the long-term 10-year horizon of committed government resources that can really help companies like GM and Ford and Stellantis and everybody else have a long-term ability to look over the horizon and say, yeah, okay, these incentives will be. And even now, so I think one of the reasons why we saw a drop in EV sales was the fact that everybody's waiting for the $7,500, which is now available at the dealership.
Yep.
So we may see this downward trend in EV sales start to rebound a bit, I hope. So spike.
Divya, provide some
I can maybe
context.
offer a few comments here. I think the first thing I'll say is that from a federal government perspective, I am really surprised in a very good way the coordination behind the scenes between the various funding programs, the financing programs. We have regular conversations with NRCan, ISED, EDC, BDC, CIB, CGF. I mean, that does not happen on a normal basis in any other industry. And we're constantly discussing projects. How do we manage funding, financing so we can move our dollars further and faster? There are processes. I mean, again, we're trying to streamline them, have one intake windows. So I think that's one part of it. From a CIB perspective, I mean, we are very similar to commercial banks, whoever's worked with us. I mean, we've had lawyers here work with us. We've worked with Desjardins. We're very streamlined. We can move as fast or faster than other banks around the industry. We can achieve financial close between 3 to 6 months, depending on how fast you've got your work done. So we're not supposed to be a bottleneck when it comes to FID. And the last thing we'll say is that when I think of creativity, we're not there here yet in the mining industry only because we're so new at it. In other industries, we've done something similar that you mentioned, which is we call them aggregation. So we work with private equity or with funds or with banks, and we will create a joint venture or an MOU where we'll say, if we had to think about $100 million investment with you, and then you work with us on smaller investments so you can move projects faster, then there are ways of doing that. So we don't have to, we meet our hurdles on size, but you know that we're going to always be a partner with you on smaller projects. So there are ways of doing these kinds of things. Again, it's just, you know, we want to move as fast as the market is going, but the market is also taking a bit of time. So I think I will say I don't know anything on predictions, but I'm hoping that in the next 6 to 8 months we'll see things in moving much faster from a traction perspective. Again, that's my hope. Selfishly, this is what I want to do at least.
Well, I think that's great. We encourage you to do so. We're excited to see some additional activity. I think we are past time. So thank you very much to all the panelists, Carlo, Dominique, Trent, Emmanuel, Brad, Divya. Thank you so much for spending time with us this morning, for getting up early, for thinking about these issues on a very detailed level, and sharing, you know, where you're at on these things. I think there's some problems to solve, but you seem enthusiastic about it. Carlo, thanks for painting a very dire picture early on. I'm joking around, but you know, we've kind of completed the movie now. So we got a solution here. We just got to go out and execute. And the gentleman in the back there's thrown down the gauntlet and told us to move faster. So thank you again for joining us here at Fasken. You know, stay tuned. We got more things coming down the pipeline. And if you're in from out of town, enjoy your remaining time in Toronto. And if you're here local, we look forward to seeing you again very soon. Thank you.
Thank you.